Alrighty, we'll get things kicked off. We'll do, kind of per usual, just a little around the horn, get a little hello from everyone. So we started with AE.
Hey guys, thanks for joining us again.
Everyone, happy Friday. Thanks for joining.
Guys, it's Wally. How's everyone?
And then as usual, cold summer here. Just we Bobby's joined us, but he's kind of on the road doing a bit of traveling right now, so not sure if he's going to be really able to speak today, but he is here with us. With that, we'll get things kicked off. Kind of excited to introduce this week's topic and talk a bit about the DeFi building blocks that sort of form the basis for the yield that we're able to farm from our top of stack position, and just kind of give you guys a little rundown and how they function, and how they generate yield, and then how that sort of trickles up the ladder toward where we farm from. So with that, I'm gonna hand it over to AE, who's going to talk a bit about Curve, and then I will talk a bit about kind of Aave, Compound, the lend borrow platforms after that.
Yeah, thanks, Summer. Uh, so we're going to discuss what Curve is, how it generates revenue, and how we can use them to, in turn, generate revenue for us. So first of all, what is Curve? It's a decentralized exchange, just like Uniswap. But the crucial difference is that it only has pools with like-for-like assets. At least their first version does. And these like-for-like assets are expected to trade at nearly the same price. So for example, the famous tree pool that we're using right now contains three different US dollar stablecoins: USDC, USDT, and DAI. Because these tokens are at the same price, or supposed to be at the same price of $1, um, Curve has a special automated market maker mechanism which concentrates liquidity tightly around this bag of $1 for these stablecoins, and that allows for very low slippage trades between. So if you're a very large user, using Uniswap can, even if you're just trading two stablecoins, can mean that you're slipping this price by 1.5%, and that's not something you want when you're making $1 million trades. So Curve is an amazing alternative, and on top of having lower slippage, Curve also has lower fees. So that's the advantage of using Curve. And besides just the USD stablecoins, you also have Euro stablecoins, you also have Bitcoin, Ethereum, Link, and probably more on the way. Now, how does Curve generate profit? Well, users can obviously, just like with Uniswap, permissionlessly deposit funds into the liquidity pools. So if you provide liquidity, you allow users to swap between your assets, and then you generate some of those trading fees, the swap fees. On top of the swap fees that you always get, you also get their native governance token, CRV. And that's CRV is interesting because it allows you to further boost your rewards. The rewards are variable; they depend on how much Curve you have locked up in their gauges, which are something that we are going to implement later on as well. You can lock up a certain amount of your CRV, and the longer you lock it up for, the more your rewards add up, the more your Curve boost adds up. And we're going to be doing the same thing in Era 2, so you'll be able to lock up your yAxis, and then you can boost rewards going to one of the vaults if you desire that. Now, how do we use Curve? Well, the main thing is that Curve is basically the base layer of DeFi right now, one of the most important protocols on the base layer. So we consider it a reliable overflow strategy, and what that is when we have a list of or portfolio of strategies that all have their own caps, so only a certain amount of funds can go into them, then Curve is the strategy that the rest of the funds go into. Instead of them sitting idle, they go into Curve. Why? Because it's relatively safe, it's battle tested, and it's also relatively low in smart contract risk because it's just one layer. Whereas if you use yield aggregators, there's usually another layer between, which is farming Curve, something else. On top of that, we also leverage Curve through those yield aggregators because, for example, Yearn or Convex, they have their own CRV tokens locked up, which means they get a higher boost. So instead of having our protocol lock up CRV into their gauges, we can just use Yearn or Convex and benefit from their boost without hurting Yearn or Convex because they still get performance fees from us. So that way we benefit from being in a top of stack position. It enables us to use the base layer, which is Curve, but also intermediate protocols like yield aggregators. Furthermore, in the future, we're obviously very close to canonical vaults right now, just 5 more weeks. When we release those canonical vaults, we can also use other like-for-like assets, not just USD, but for example, the Bitcoin pool they have. One of them is, they have multiple Bitcoin pools, but one of them is the Rand pool. That's pairing two different wrapped Bitcoin assets. That means the value between them is equal, or supposed to be equal if they keep peg. And if we deposit Bitcoin in there, we don't suffer from impermanent loss. We consistently receive more Bitcoin from those swap fees by providing liquidity, and we get those CRV rewards on top, which will be sold for more wrapped Bitcoin assets. Now, similar pools also exist for Ethereum, Ether and Link, so we can use Curve for basically everything. It's very valuable to us and pretty much integral to our success. We really depend on Curve just as much as other yield aggregators. So that's the first one of the major base layer protocols that we're interested in right now. On to you, Summer.
Yeah, awesome. Thank you for that, AE. And before I kind of pop into the Aave and kind of compound side and just those like lend, borrow, money market type protocols generally, feel free if you had any questions that sort of popped up throughout AE's sort of description there. Feel free to toss them in the chat, and we'll go through them later. Yeah, so kind of just moving on now to Aave and Compound, and this kind of goes for Cream, for example, which is like another fork, but we'll kind of just keep it to Aave and Compound for general purposes. So, similar to kind of a bank, basically some users are just depositing assets, or you could consider them like collateral, and then kind of other users are just borrowing those assets. And that's generally how it works. So it's similar to kind of a traditional bank that you would expect. That's sort of just how it functions. And then so users, the users borrowing those assets could be the same users that are just borrowing against their own collateral, like own assets they've deposited, or there could be somebody that's only depositing assets, and then a different market participant is borrowing borrowing their assets they've deposited. Right now on kind of Aave and Compound, the largest markets are stable coins. So there's a lot of borrowed demand for stable coins, and then obviously a lot of deposits of stable coins as well, considering people want access to these yields, but they don't want to take any principal risk on an asset on the underlying that might fluctuate in value. So they just want low risk returns and getting yields that are far superior to what you can get in a traditional bank account or in traditional finance, kind of as we discussed last week. So the biggest way that these protocols kind of stay protected is that when you're borrowing, you must stay kind of over collateralized. So you always have to have more asset posted as collateral than you can withdraw. I mean, then that you can borrow. Sorry. And this kind of just protects the integrity of the protocol and ensures that all users can always repay their debt, because you can't have, if somebody defaults on their debt, that kind of creates a systemic risk for the protocol. So you want to make sure that how they kind of overcome that is just making sure that everyone is over collateralized, so they're always putting up more collateral than the value of the assets that they're borrowing. So basically, if the value of that collateral, or it's often called like a health factor, falls below a certain level relative to that amount borrowed, the user faces some liquidation risk. So and like I mentioned, liquidations aren't really bad. They actually protect the protocol and protect the users. So basically, now that we've kind of gone over the basic mechanics, how is the yield essentially generated? So it's the yield essentially represents the the demand for borrowing the asset relative to the supply of the asset deposited. And so this is often referred to as kind of like a utilization rate of the capital that are in these pools. So let's say there's $50 million worth of USDC and deposited in the pool, but there's only 1 million borrowed, which would be only a couple percent utilization rate. The yield on the deposited assets will be extremely low, because not much of that capital is being used. There's not much borrowed demand relative to the asset that's being supplied. But let's say there's 50 million of USDC in a pool, and 49 million of that 50 million is borrowed, then the yield obviously is going to be extremely high based on that kind of demand supply balance. So this sort of creates incentives where the market is incentivized to borrow more when the yield is low, and supply more capital or borrow less when the yield is high. So the yield is kind of constantly re-equilibrating. And that creates kind of opportunities for a base layer to kind of form where yield aggregators can build on top of that, because they can deposit stable coins in in a pool on, let's say, Aave or Compound, and maybe chase the pools that are offering more attractive yields, and then maybe they add a little bit of governance token on top, and then we sit a layer above that, so we're farming like the underlying Aave and Compound, and also the governance token that they're adding on top. And currently as well, kind of concurrently with that base sort of yield that's driven by the supply demand, is you have these liquidity mining programs where right now, Compound and Aave are basically paying you to use their product in the form of their own governance token. Um, so kind of like I mentioned before, just similar to Curve, they kind of form a nice base layer where many yield aggregators and protocols kind of plug into and utilize these platforms as a base, and then we sit at the top of stack and either interact with them directly or often through an intermediary that's generating some type of yield on top, and then we farm both of those yield sources. And then sort of in our future, kind of as AE was hinting at before a bit with Curve and the options with some of the other assets that we'll have in Canonical Vaults and in V3, we're also going to be utilizing Aave and Compound for delegated strategies, where we will deposit, Ethereum, Bitcoin, Link, and we will basically be depositing these assets, kind of as I was mentioning earlier, as collateral, and then borrowing against those assets. So you're not going to be earning much yield inherently on the Ethereum, Bitcoin, and Link that you're depositing, but you can withdraw and borrow stable coins against those assets, and then find a higher yielding farm out there on the market. Like, let's say we were to borrow USDC from Aave at 5% yield, and then go deposit that USDC through Convex and earn 15%, and then we make a nice like 10% spread on the underlying, and then from there we have yAxis emissions on top, and you start to really talk about a really attractive yield for some of these assets that's industry leading, and we'll go into that in a little bit more depth in a little bit in response to I believe it was Timitos who asked a question about that. And sort of also talking through, I mentioned a little bit earlier about liquidation risk, and talking through a bit on how we plan to keep funds safe through all of that in the delegated strategy process. So transfer and call, kind of mentioned this a little while back, but basically on kind of every interaction, the vaults will be determining their health factor, and whether they can borrow more to earn more yield, so borrow more against the collateral that we've deposited in the form of Ethereum, Bitcoin, Link, or if they need to pay back some of the loans to make sure that health factor stays in check. And that, combined with Chainlink's keepers for some automation, will help avoid liquidation risk, and obviously security is always our number one priority. So wanting to continue to take that through in everything that we do. So with that, I hope that was helpful. And like I said, if any questions pop up on some of those, like the major base layer protocols that kind of form the basis of all of DeFi, and trickle all the way up to the top of stack position that we sit, feel free to toss those in the chat as well. With that, we're gonna move into the predetermined questions that people had kind of asked in advance, and then we'll get to the live ones, as many as we can. So the Tisk ask DeFi building blocks, how do they function? Well, hopefully today kind of helped with that, and always feel free to follow up with more questions, either in the chat or personally via DM. Always happy to help and happy to answer. Zemus asks, the traditional question of the week is, you guys still think we'll all be friends at school on Monday? My response to that is that yAx don't go to school, so I don't know about that one. But Crypto Force One asked the meaning of the Discord names of the team and different people that are kind of involved with the project. Why they were picked, and do they relate to the project? So rather than going through an exhaustive list, I just went through some of the ones that were maybe a bit more notable. Get Gouda is like get cheese, get money. Dog. I'm gonna butcher the pronunciation here, but Dog Pero Kukur is dog dog dog, and then transfer and call is this actually relates to the project, and it's the ERC 677 functionality that we have with our token, with the yAxis token, which is it's transfer and call functionality. So that's kind of where the name comes from. So that does directly relate to the project. And then moving on to Rob the Posh asked about insurance, and we've discussed this a bit in a few, kind of throughout the Discord and a few other Yherds and weekly yAxis, but happy to kind of readdress this and provide a bit of an overview. And so basically how the insurance is generally going to function. So this is again like we're going to do an in-house solution, and it's going to be built out in later in future eras. But it's the way transfer and call describes it is basically that users of the vaults can essentially lock their vault token. So as of right now we have the MVALT token, which represents your share of the vault. So users can lock that into a separate contract. And in the case of an insurance event, as determined by governance, that collateral would essentially be used to credit and backstop the other holders in the vault. And then as a reward for collateralizing the system and doing that, they'll obviously earn extra yield, and we'll kind of let the free market determine what the yield should be and how that's gonna sort of all weigh out. And obviously there will be some variability in that. The yields will kind of go up and down, and the market will sort of determine what the sort of fair price is for providing that insurance and that collateral backstop. And be nice to see it just baked into the yield, so you won't even have to go to a third party insurance provider solution and hope that they pay out, or hope that they define your situation as an event that requires reimbursement. So just taking care of all of that in house. And to provide a little bit more color on that, so it's basically similar to like a tranching implementation that you've seen some other protocols kind of hint at, like a Saffron or Barnbridge. And then if an insurance event does happen, like the people that are collateralizing the system by locking their vault tokens in that separate contract, they don't necessarily like lose instantly though. Like they're not going to get liquidated. They'll just kind of be locked in until the debt is paid off. And so this is kind of a common question that we get from time to time, is that why not have yAxis holders and stakers collateralize the system as many other projects do? And basically we'd rather just let the vault users themselves collateralize the vaults via let's just create the market incentives and set up the market incentives and let the market go to work, and not like put the burden on yAxis holders, especially because in that implementation, as you saw with SNX last night, actually, when you collateralize your own system with your own token, when an event happens, you have to sell your own token. So it sort of puts unnecessary sell pressure on your own token. So would rather let's create the market incentives and then let the vault users decide that. So I know there's a lot to unpack there, but hopefully that was generally helpful. So ZZZ1 asked about the smart contract double audit and what is common in the industry and how the audits work. So it's pretty common for most projects to get anywhere from 1 to 3 audits, especially for core releases. And it helps, having the double audit helps get multiple perspectives and a couple eyes on, and always happy to have more than one set of eyes to get multiple perspectives and ensure that we are being as secure as possible. And this also served as kind of a test run to see like which auditor we really liked working with better, to kind of help decide how we want to dictate future audit needs and who we want to kind of go to. And just a basic, you asked like how do audits work, and just like the basic sequence is like we pay an auditor to kind of review the code, and they sort of produce a report with potential issues, and then we kind of just go in and fix and respond to the issues that they identify, kind of as needed, depending on severity, and from there they kind of produce like a final report, which is made public. And then this last question is a fantastic question as well from Timmy Toes, where he asks, I know it's super hard to predict this type of thing, but do you have any idea for what sort of TVL we're hoping to reach during Era 2? And as a follow-up, presumably institutions won't be investing in a brand new product. So is Era 2 TVL expected to mainly come from private investors? So, a couple things to that point. So we did a bit of a deep dive on the TVL being targeted and expected in week 3, but kind of in short, I'll do like a quick, recent market overview. And there's about 240 million in TVL of Ethereum on Alpha, earning 6% yield. There's 140 million TVL of Ethereum on Yearn, earning 3% yield. 120 million of TVL of Link, earning 5.5% yield on Curve. The list goes on and on. I didn't even get to, didn't even mention Bitcoin yet, but you have a lot of these different solutions that are providing low single-digit yields. And basically with the emissions allocation outlined in YIP 9, canonical vaults could offer like a 22% boost to the underlying strategy, even at 400 million TVL with yAxis at $20. So obviously about, that price is about double from today, but you still give an idea that even at today's price, still would offer a considerable boost at scale of, a couple 100 million TVL. And, that TVL is very easily on the market because we basically could, plug one of those underlying strategies of, we'll call it 5% yield, and then add on a nice boost to, we're talking, 15, 20, 25% yield, which should be able to, and that's at scale, which should be able to draw and retain big TVL. Never mind what it would be at, the scale of 50 million TVL. So, given the other rates, on the market, I think we're in a considerable position to draw and retain big TVL, and we can offer yield at scale. And kind of as you mentioned, yeah, like to start, it's going to be a lot of private investors, which is why we're kind of in that emissions phase to really cater to speculative crypto native capital and prove the V3 and canonical vaults can operate securely and efficiently at scale. And then it becomes much easier to point to a few 100 million in TVL in these vaults. They're operating securely and effectively. It becomes much easier to turn around to, large depositors like mining pools and other project treasuries and institutional capital, and say, here, you can earn an extremely attractive yield here. We've been operating for X amount of time at scale with no issues. And we have all of these amazing security features, and security is really our really our DNA. So kind of stacking all those things on, you can really make a great case. So that's why, really having the emissions phase sort of as a bridge to attract that speculative capital and improve the ability to operate at scale. With that kind of closes out the questions that were asked in advance, and then we'll move into some of the questions that we had live today. So Waldorf and Sats asked, what is the rhyme or reason behind the timing and size of the buybacks? So basically, we've kind of discussed this a bit, but so and even talking like with what A is referring to today. So if we're LPing on Curve, So if we're providing liquidity on Curve, then eventually Curve is giving us CRV tokens in reward for providing liquidity. So when it makes sense, so usually every few days, when it makes sense from a gas efficiency standpoint, if we've kind of accumulated enough CRV, it will be liquidated, and then some of it is put back to work in the strategy, and then others are used to buy back yAxis from the open market. And then right now those are being stored in the public address for distribution in the Great Harvest, which will be supplemented with the flexible allocation from the Treasury, but kind of long term looking to distribute those buybacks sort of in real time to stakers. So that's sort of just the size of the buybacks is just determined by our TVL and the value of CRV at the time, and both of those are obviously variable. And over time, like let's say over a week's time frame, we would obviously buy back more than we would over a couple day time frame because we've accumulated more CRV. So Hamza asked a good question. The delegation feature, is it live on some other project? And yes, so that is, you've seen it. Yearn actually just launched a link delegated vault actually. If you wanted to check that out, we had a little discussion about that the other day. Basically, depositing link on Aave and then borrowing against that, and they were borrowing SUSD and putting the SUSD back to work in their own vault and trying to capture that bit of spread, earn a bit of yield. The nice part is, we can just sit here, and if that's successful, we can just plug into that directly, or we can, find our own delegated strategies, and we have a lot of flexibility there. It's a nice part about kind of being at the position in the yield stack that we are, where we can kind of just be nimble and think about things with a broader scope. And Flynn asks, are there any other projects developing an equivalent product to yAxis that boosts yield to a similar value? Yeah, I mean, there's obviously 1,000,000,001 yield projects out there right now, but in terms of like anything that's actually reputable, that's offering the yields that we are, I mean, I would say pretty unmatched in that standpoint. I mean, we just did a little brief dive on some of these, the amount of TVL in a lot of these different places earning very low yields, and so we'd be happy to scoop over and attract a lot of that TVL to deposit through us, and then we'll earn some revenue by doing so. And obviously it's still a pretty infant space, right? So one yield isn't necessarily directly comparable to another yield, because like for instance, like we take security very seriously and we have a lot of different security features. So our principal risk, like the risk you're taking when you deposit capital in like yAxis's vaults, is likely lower than many of the other vaults in the market. I mean, we talked a little bit about in Discord recently how we don't have there's no flash loan risk with our vaults, which was the attack vector that Yearn experienced actually a little while back. So we're even more secure than them in that sense. So you have to think not only in terms of what is the nominal yield, but also what is the risk adjusted yield. And I think that is a game that we really excel in. All right. With that, I mean, we're at the halfway point in the hour, and usually looking to wrap it up about now. But if there's any last minute questions, feel free to toss them in and we'll get them answered. And then if not, happy to connect via DM or in the Discord as well. Alrighty, looks like the questions are wrapped up. Thank you again for all the great questions. We had some really good ones this week about vision for the project and security and some of the places that we really differentiate ourselves. So I think that was good, and hopefully you guys all learned something about the base protocols at work and how we leverage those from our position. And looking forward to continuing to see everybody on future episodes, and appreciate all the loyal support.
Yeah, thanks a lot, guys.
Thanks, Cold Summer and
everyone.
AE, and thanks everyone for joining. Happy Friday.
Thanks everyone.
Yeah.
Take care, everyone.